Okay, in this video we're going to discuss the uses or applications of repo transactions and the risks that may be that may come around or come about from using them, from using the repo, that is. So let's think first about the different ways in which repurchase agreements are used, so repo uses. And your book, your curriculum actually focuses quite deeply on 3 uses, although I would venture to say that there potentially is more than 3. The first one of these, and we're going to take them one by one, is financing the ownership of a financial security, like a bond, for example. Now, there are many ways to potentially portray this problem or illustrate this problem and talk about it, but the one your book kind of favors is: imagine a financial institution over here, financial institution like a bank, for example. A bank doesn't have to be a bank, but a bank is a good example of this. Now, a lot of the time, what banks do is they trade, or they intermediate in the financial markets as dealers. So they buy and sell different securities. If somebody wants to sell, a bank will buy from you. If you want to buy, a bank or dealers working at the bank will sell to you. That's what I mean by intermediation. It's called being a dealer or a market maker. And so imagine over here you've got a client. This could, for example, be an institutional client, like maybe an investment fund. And let's say they want to sell a bond that they currently hold. So they come to you, the dealer, and you have to pay them cash for this bond. Now, obviously, as a result, you end up holding some kind of inventory of those securities in which you trade securities, because the idea is, as soon as possible, I guess, without any intentional delay, you would try, being the bank, you'd try to sell that bond on to, somebody else, another client, another party, somebody who wants to buy it, and try to get out of it, holding the bond in that way. But there is a delay here. You're not necessarily going to find that other party instantaneously. You're going to, at least for maybe a couple of hours, maybe a couple of days, hold inventory of the securities that you buy from your clients, which you buy for trading purposes. This is not stuff that you're buying to hold for yourself, but you're buying this for trading purposes, with the intention of selling it on. Now, the trick or the snag is, over here you have to pay your client, the one from whom you bought, the full price. So client must be paid the full price, the full security price, even though the bank hasn't sold this on yet. It has to settle with the client. So one thing it could do to generate the cash necessary to pay that client, essentially to fund their position, their long position in the bond, is to indeed take the bond and sell it to another party. But this is not an outright sale. This is not me selling the bond and getting the cash yet for good. I'm going to sell it to another party, be it another bank or maybe a fund like an asset manager. But I'm going to sell it as part of or under a repo. What I essentially am trying to do is I'm trying to borrow money from that other party. So you could say that this purchase price, which I receive from selling the bond, is at least temporarily borrowed under the repo. And I do it, essentially, this is where you need to make the connection. I borrowed the money to fund the cash payment to my original client. To fund the cash payment. The cash payment that's made over here to the client from whom I bought the bond. Obviously, if I traded the bond on immediately, if I sold it to somebody else kind of outright immediately, I'd have the cash coming in from them. I could settle with this client and there wouldn't be such a delay. But here I temporarily need to fund my position. Now, and I'm going to borrow money to do that, and the repo is a great way to do so. Please appreciate that under the repo, this purchase price over here is not going to equal the full price of the instrument. We discussed in the previous video the notion of haircuts and initial margin over collateralization. So because the purchase price here is going to be lower than the security price, and that's the cash payment that I need to make to the client, the bank will still need to fund the difference. Bank needs to fund the difference, the delta here, but you know, funding that difference is going to be much easier than having to fork out the full cash price over here out of the bank's own resources. Okay, so that's one very important use of the repo, financing ownership of a security that you've bought, for example, from a client if you're a bank. Another reason that you need to be aware of is, well, this one I guess is a little bit easier and kind of more obvious to everybody. You may enter the repo, but now we're thinking from the perspective of the cash lender, from the security buyer's perspective, so as to earn. So the use is to be earning short-term income from secured lending. So basically earn the repo rate that you charge on secured lending. And as I said, this is from the perspective of the cash lender or the security buyer. Because repos, I consider to be very safe, especially if you use good quality collateral. So if you use good quality collateral, this is going to be done with the very minimum or very minimal credit risk, and also very small liquidity risk, because if you receive good quality bonds as collateral, it should be quite easy to potentially sell them if the other side has a problem repurchasing. However, how much you earn or how much income you receive from the short-term secured lending transaction, the repo, well, the actual rate of return on this is going to be, will depend on the term of the transaction as well as the collateral being used. So it's going to be the lowest for overnight repo, the shortest term possible. So obviously under normal conditions, overnight lending attracts a lower rate of interest than longer term lending, especially with high quality collateral being used as security here. And accordingly, that rate of return that you earn as the lender in a repo is going to be much higher, or definitely higher, for longer term repo trades, especially utilizing lower quality collateral. So not necessarily the best quality bonds issued by governments, but something else. Bear in mind that repo transactions may also be secured on instruments other than fixed income, so you can use shares, for example, as security, and that's definitely more risky. So who are the institutions that try to earn money from doing this, from being the lender. This is typically done by banks, other financial institutions, i.e. non-banks. Insurance companies can do this if they've got a lot of cash. So other financial institutions, I said insurance companies, especially life insurers, are kind of institutions that sometimes have a lot of cash around that they want to invest, possibly in a safe way. Mutual funds, obviously pension funds as well. Anybody can actually do this. And just one more little note here, because your book goes into this, but a bit. But more on this is discussed. Well, more of this gets discussed in the economics section of the curriculum under monetary policy. Another possible lender. Remember, we're talking here from the lender's perspective about this motive specifically. Is that central banks quite often get involved, and they often use repo transactions. So they use repos to affect or to influence the money supply in the economy. At least short-term money supply. Long-term money supply is typically influenced by other tools or other measures, but repos can be used to influence short-term money supply. What's the point here, or what's the deal here? If you imagine, normal commercial banks, so high street banks and other banking institutions, and the central bank. What the central bank may encourage is that commercial banks sell fixed income securities, bonds, and typically central banks will have a defined list of instruments which they accept as collateral, and in return give them cash. Now, once again, the point is, this is not an outright sale to the central bank. This is a sale connected with a commitment to do an offsetting trade in the future, so combined with a later repurchase, so a classic sort of repo. And the point is to provide cash to commercial banks, to banks operating in the economy, to temporarily, so let me say the aim here is to temporarily, in the short run, increase the cash reserves of the banking sector. That's basically the amount of money that banks have on their accounts at the central bank, something that we referred to previously when we were discussing short-term funding of financial institutions as central bank funds. That's one way in which the central bank performs such injections of liquidity to the banking sector, but it does it under short-term borrowing, so repo transactions, with typically with high-quality collateral flowing the other way. Okay, so I think that's enough on this motive. Your curriculum really doesn't discuss this to any sort of greater extent. Let us now focus on the third motive, the third reason, and this one's going to be quite a big one, in the sense of we're going to say quite a lot about this, and also do a bit of a numerical example following an example that also appears in the book. So the third motive is borrowing a security, for example a bond, so as to be able to sell it short. I.e. take a position against that security, basically a bet that it will fall in value. Okay, now this is often, or short selling is often associated with hedge funds. Hedge funds often follow short strategies, or they pick instruments which they want to short. So your book also focuses on sort of hedge fund inspired examples. Let's go through such an example. Let's say we've got a hedge fund whose manager expects the price of a bond to drop. So hedge fund expects the price of a bond to drop. Okay, now one way to try and make a profit from that expectation, obviously all of this hinges on the expectation being correct, but if it is, what we can try to make money is to take the following steps. First of all, you need to, as the hedge fund, borrow the relevant security. So borrow the bond in the repo market. So what you'll do, here's the hedge fund, smack in the middle. Okay, so as the hedge fund, you'll go to whoever has that bond. This could be a mutual fund, for example. We're going to, just like in the previous video, describe them as the security seller, because they are going to sell the security to you. You're going to be the hedge fund, you're going to be the buyer of the security. In this context, the security buyer. But I think it's easy to think over here of your role as the security borrower, because you're going to have to return that security later on. Okay, right now you're buying it, you're paying for it, so the bond in question goes this way. Obviously cash flows the other way. This is going to be the purchase price, and kind of immediately after this has been achieved, immediately following the borrowing of this bond in the repo market, we do the second step, and that is to sell the security in the cash market. That is, perform an outright sale in the market for cash. So outright sale without any strings attached. So here is the market, and you find somebody, typically a dealer, who is willing to buy the bond because they specialize in dealing in this bond. So the bond which you just borrowed, you sell in the market, perhaps to a dealer, and receive cash. This is obviously the security price. Following the logic from the previous video, I was very careful to make the distinction between the security price, its true market value, as opposed to the purchase price, what we receive for it under that initial repo sale or repo purchase. We expect the price of the bond to drop, so let me also say that this is presumably a high price right now. If it's going to get lower, then this is a good high price which we received. Now, because this is a repo, it's going to have subsequent consequences at a later date. So what will happen on that later date, whenever it is? Well, we will go back to the open market and we will buy that security back in the cash market, obviously the equivalent security in the cash market, and we're going to buy it at whatever is the current market price. And if our previous forecasts turned out to be correct, the bond should have recorded a drop, so hopefully it will be a lower price at which we will be buying this thing back. So once again, let me draw the market over here. This is once again us, the hedge fund, in the middle. And now we buy the bond back, hopefully, if all goes well, paying a cash price which is a lower price than before. And of course, we have to return the bond to the original security seller, who's here, who's now performing the repurchase. So they are paying us back the repurchase price. over here, and well, if this indeed is a lower price than the price for which we initially sold, then during those couple of days, couple of weeks or whatever, we should have made a profit. This is how you can get your hands on a security that you intend to sell short in the market, and you temporarily borrow the security this way. And it's also important to note that if you talk to a hedge fund and ask, you know, what are you doing, then from their perspective, so let me say from the perspective of the security buyer, that's the hedge fund, who's also the cash lender in this transaction, because they're providing, I guess, economically a loan to the security seller. So from the perspective of the security buyer, the cash lender, who in our example is this hedge fund in the middle, this transaction, the way they would probably describe it is they would say, we've done a reverse repurchase agreement, or just simply a reverse repo, because being on the other side of that transaction means you do the reverse. You will not be repurchasing the future. You'll be doing the reverse. This security seller will say, I've done a repo, but the other side may say, I've done a reverse repo, which is the same transaction, but just the other sort of the other end of it, the other perspective. Please be aware of it. It's quite an important point. Okay, let's do a little bit of an example. This is an example which is very much inspired by something that you can find in the curriculum. Although it's a very simple example and it really ignores a lot of the interesting details that we talked about before, like initial margin or variation margin. So I'm going to say example. Please appreciate that this is based very much on the curriculum, and the level of detail which I'm going to show here is what the curriculum gives in this section at least. It's going to be ignoring, so it ignores the idea of initial margin and any variation margin, which is what kind of may need to be provided during the life of the repo, a variation margin. Okay, with that disclaimer, let's focus on some data, on some details. Imagine that the initial security price, so that's, when I say initial, I mean at time 0, when the repo is initiated, when the repo is entered into, is going to be 100 million euros. So that's basically the market value of a security like a bond, but because we're ignoring initial margin, or basically assuming that initial margin equals 100%, there is no excess, or the collateral value is exactly how much you receive in terms of the purchase price. I'm going to say, well, this is equal to the purchase price, this is how much you receive, this is how much you will have to pay to get the bond from the other side, purchase price, to borrow the bond. And let's also assume that this is equal to face value, so the bond is trading at par. What is more, the repo rate is going to be, I think I used this before, right, in a previous video, 4% per annum. Let's keep that the same. Let's also assume a repo term of 15 days. I think I used that before as well. Let's also assume that all the computations for scaling up or down to the actual number of days are done under the assumption of a 360-day year. As I said in the previous video, even if you're not explicitly told to use that assumption, do it, because that's how at least this section of the curriculum works. It uses that assumption quite a lot. And the additional piece of data that we're going to have is that the security price, so basically the market value of the bond, of the collateral, after those 15 days, so when the repo term is over, it's going to be just 98.5% of face value. So we're starting off with a bond worth 100,000, which subsequently drops to, I guess, 98,500,000, 98.5% of the face value being 100 million. Okay, and I want us to do something quite simple. Calculate the return. It's going to be a percentage return to the hedge fund. And obviously the assumption is the hedge fund who acts as the cash lender in the transaction, or a security buyer, or in fact a borrower of the security, buyer stroke borrower, buyer stroke borrower. Now you may find this confusing. Why do we have so many different ways to describe the same person in the transaction? Well, this comes from these transactions being used for a variety of purposes. For some, they're buying the security, for some they're borrowing the security to use for other needs, for some it's more about the cash lending. You know, there are different motivations for entering the repo, and that's reflected, I guess, in the names we give to the two sides. So our hedge fund, so to speak, is over here, smack in the middle, and just like before, they will be getting the bond, at least temporarily, for 15 days, and they will pay a purchase price for it. That purchase price is the price up here. We're saying that the purchase price equals the security price because initial margin is 100%, which also equates to the haircut being 0%, because we're not shaving anything from the security value or the security price when determining the purchase price. So 100 million euros gets paid over here. Good. And of course the hedge fund subsequently sells the bond in the cash market and receives well, the same 100. And you can see that, of course, this 100 million can easily be used to launch to settle the original transaction, to pay for the purchase or the borrowing of the bonds. Now, 15 days later, you probably know already what's going to happen. The hedge fund goes back to the cash market, and purchases the bond back over there for whatever is the current price. And we said the current price after 15 days, or the price after the 15 days are over, is 90.5% of face value. So they get the bond back, and they have to pay 98.5 million euros going this way. And obviously it would be very easy to calculate the return on this, on that aspect of it. What happens in the cash market? You previously received 100, now we've got 98.5. Very good. But over here, when you as the hedge fund return the bond to the sort of the original owner, you receive a payment, and that payment is the repurchase price. And the repurchase price, given a positive 4% repo rate, is going to be higher than the initial purchase price. So you've actually got two sources of income here. On the one hand, you manage to buy the security back for a lower price in the market, and here somebody's paying you back a higher amount because you've lent them money and now they're repaying you together with interest. So our job is actually going to be now to compute especially this repurchase price element, isn't it? Because you know, that's the thing that's not so easy to calculate without turning on our trusted calculators. So what's this going to be? It's going to be 100 million, obviously the initial price, the initial purchase price, that always feeds into the computation, and we're going to increase that for the interest aspect. And you should by now be used from the previous video to how we actually do this computation. It's 1 plus whatever was the rate of interest or the repo rate. It was actually 4%, so 0.04 scaled down to the 15 days out of a presumed 360 days in the year. Okay, close the square bracket. This is the computation that we need to perform. So let me just quickly fire up my calculator and input the numbers. So let me deal with what's in the bracket first. 1 plus 0.04 multiplied by 15 but divided by 360. What does that equal? Okay, if I multiply that by 100 million, right, I'm going to get a repurchase price of 100,166,600, and okay, let's round this to a full euro, 667. So the return to the hedge fund, or the profit which the hedge fund makes from this transaction, I guess this would have been a more accurate way of putting it. Returns typically bring about connotations of a yield, an interest rate measure, but the return to the hedge fund or the profit which they generate from this overall transaction is composed of two things. It's the difference between actually the money coming in from the security seller and the money that had to be spent in the cash market. So essentially 100, 166, 667, that was the number up here, minus 98.5 million euro over there, and the difference is okay, I'm going to resist the temptation to do this on the calculator. I think I can quite easily do this in my head. It's going to be just slightly north of 1.45 million. It's going to be 1,666,667. Right, the difference between these two numbers, I think that's the one. If I was sitting the exam, I would have a choice of ABC D answers, or ABC answers to choose from. When I took this exam many years ago, it was in fact ABCD, so I sometimes make that mistake still, and maybe it would have been easier to pick one, but that should be the total return to the hedge fund from engaging in this transaction, assuming that the security price did indeed drop to that lower level. Okay, now one pretty important point to kind of raise here is that if you are using a specific security because you want to sell it short, because your research suggests that it's going to drop in value, right? You don't want any sort of, or any collateral. You want a specific security to be used, so not general collateral but specific collateral. Then that may create some complication. This transaction, the one above, right, calls for, as in it requires, a specific security to be used as collateral. Okay, we kind of know that. That's stating the obvious. And it will typically be described as a special trade. Because of the requirement to use specific collateral, and such special trades are also done under a special repo rate, which may be different to the rate if you used general collateral. Sometimes when a lot of participants in the markets expect a specific security to fall in value, for example a specific bond from a given issuer, there will be a high demand to borrow that security under repo agreements. So if there is demand, or if demand to borrow the specific collateral, and the reason why you want to do it is because you believe its value is going to drop, if demand to borrow specific collateral is high, okay, then that special repo rate, the repo rate, the interest rate associated with these transactions, will actually be lower than the general collateral rate. Remember, the repo rate kind of dictates how much the security seller over here has to pay you back in excess of what you gave them initially. If you gave them initially 100 million, they have to pay you back 100,166,667, and this is a product, among other things, of the repo rate. The higher the repo rate, the more they have to pay you back when you return the bond to them. But if I'm a hedge fund and I'm quite desperate to borrow this bond, one of the ways in which I'm going to motivate or incentivize the lender, the security owner, the lender, to provide that bond or lend the bond out to me is by making that repo rate lower. Or in fact, if demand is really high, I'm going to give them money, they're going to give me the security, and I'm going to even say, let's make this rate negative. So the special repo rate may even be negative, because I so badly want to get my hands on that specific security, that specific bond, let's say, that I'll give you 100 million and you only have to pay me back at some future point, right, 15 days later, less than 100 million. So in fact, I'm going to pay the hedge fund, I'm going to pay interest to you simply because you give me access to a security that I badly want. So if this becomes negative, it means, or it implies, meaning that the security buyer, in our case that was the hedge fund, who's also of course the cash lender in the transaction, pays interest, paradoxically, kind of, to the cash borrower, because the big thing, or the big driver for the transaction, is to borrow the security, not really the cash. Okay, hopefully that's quite clear. Okay, so these are the three uses of the repo. We discussed them one by one. The final one, as you saw, was the biggest, doing or borrowing securities that you would want to short. The other was earning a short-term return from lending out money in a collateralized way. So this is from the perspective of the cash lender. And the first one that we discussed from the perspective of potentially a dealer, a securities dealer, is funding your short-term holdings, your inventory of securities that you need to hold because you're buying them from clients, and before you can sell them to other clients. you need funding. Okay, let's now quite briefly discuss the factors that affect repo rates, their actual level. So factors affecting the cost of doing repo transactions or repo rates. Well, first of all, they're going to be highly correlated with the sort of general money market rates. Short-term rates that exist in the money market. The money market is the segment of the financial markets where we borrow and lend money short-term. And that's going to be very much influenced by the level of interest rates set by the central bank. Now, another aspect, quite obvious, is the quality of the collateral, so collateral quality. You kind of know, you should know that the repo rate is going to be higher, so it's going to be more expensive to borrow under a repo for lower quality collateral. If you supply lower quality collateral, and it's going to be definitely even higher, especially if you use equity securities as collateral. I've mentioned a couple of times already that that is absolutely possible. Or if, for example, you use emerging market bonds as collateral, then yeah, you're going to get a high repo rate and a high initial margin, and also by virtue of that, a high haircut. You're going to get a much lower rate if you use bonds issued by governments from developed countries. Something that we'll be discussing, that split into emerging market and developed countries, developed markets. We're going to discuss in a subsequent section on sovereign debt. Okay. Another thing is the repo term. Always, longer maturities, longer terms, longer borrowing terms. So borrowing term will bring about a higher repo rate, or a higher lending rate, basically. That's quite natural. In financial markets, when conditions are normal, so when we've got what's known as a normal yield curve, rising yield curve, interest rates for longer term borrowing should be accordingly higher than interest rates for shorter term borrowing. So that's just a reflection of a very general observation that we make in the financial markets. Another point, very specific to repo, is collateral uniqueness. And this is something that we mentioned just a moment ago. If there is high demand to borrow a specific security, that will drive the repo rate downwards. I discussed that mechanism just a moment ago. Simply people want to borrow it so much they're happy to give cash to the other side and don't expect much interest in return. Something that I remember seeing in the end of chapter questions, I think end of chapter or somewhere within the text, is the point that typically the repo rate is going to be lowest, or at least very low, for the most recently issued government bonds. Government bonds. At least in the developed markets, we call those most recently issued bonds so-called on-the-run securities. On the run securities. So don't be surprised to find a theoretical question on this. And okay, one final point. The repo rate also may depend on collateral delivery. In fact, it surely does. And they say, what the authors of the curriculum, this part of the curriculum say, is expect a higher repo rate if the loan is under collateralized. Collateralized, that is arguably one of the longest words in the CFA curriculum. Under collateralized meaning initial margin is below 100%. So you give me a loan with a certain market value, you give me a bond with a certain market value, but in return I pay you cash, so I give you a loan which is higher than the value of the collateral received. That's an under collateralized loan for you. Let's wrap things up with a discussion concerning the risks of repo agreements. I mean, most people assume that repo transactions are very safe, and indeed they are quite safe. The repo is designed in the way it is so as to make it safe, but there are risks nevertheless, and one shouldn't definitely neglect them. Typically, the risks are lower if you use, high quality collateral, etc. But still, there is the risk of default. By default, we mean the default of the counterparty to the trade. However, we've got the collateral at least. Please bear in mind, however, that if there is some crisis conditions in the markets which cause your counterparty to a repo perhaps to default, that may also cause more general commotion in markets, more trouble in the markets, and lots of securities may be falling in value because of a general move downwards. So the collateral may drop in value, the market may become quite illiquid and reluctant to trade, so it may actually be difficult to quickly and easily liquidate the collateral and turn it into cash. What instruments which are liquid and valuable and stable under normal market conditions may turn unstable and illiquid if conditions deteriorate. There is, of course, this is kind of something I already discussed, collateral risk. But your book here says, okay, please make sure that if you accept collateral against a loan that you've given to a counterparty, that collateral should have the minimum amount of correlation with the credit risk of the counterparty. Let me write that down. The collateral accepted should have little or best no correlation with the credit risk of the repo counterparty. So for example, if you've done a repo whose other side, so if you've lent cash to a corporation, you shouldn't accept as collateral bonds issued by that corporation, because if the corporation defaults on the repo payment, on the repurchase of the bonds, their own bonds will lose value as well, because they're issued by they come from the same issuer. Okay, another risk is margining risk, and this is kind of more operational. You see, repos require constant monitoring of collateral value and issuing margin calls notices to for one or the other side to supply or give back collateral variation margin. So the collateral involved absolutely must be valued correctly in a timely way. must be valued accurately, correctly, on an ongoing basis. And if you don't have the resources to perform that computation, well, the repo won't really keep you safe. Obviously, this is done so as to be able to affect and compute variation margin. And one idea to minimize this margining risk and collateral value, collateral valuation bothers is to outsource this to a third party under a tri-party repo, which we'll discuss in just a moment. There's also legal risk. This very much depends on where the transaction is done, but depending on jurisdiction, repos are viewed differently from the point of view of who actually is the owner of the collateral. So you have to think about your own ability to enforce for your benefit the rights that you have under the repo agreement, especially the right to keep the collateral or receive the collateral and keep it in the case of the other party's default if they get into trouble. Now, another one is, but you'll be happy to know that this is the final one, netting and something called settlement risk. What's this? This is the risk associated with the ability to net mutual obligations. Let me write this down and I'll explain it in the best way I can. The risks or risk associated with the ability to net mutual obligations. So, for example, if I borrowed money from you under a repo agreement, I gave you collateral, but from a completely separate transaction, you owe me money as well. If I get into trouble, I would like to make sure that our obligations are netted, and you can't just go off with the collateral without taking into account the fact that you also owed me money. That's what we mean by netting. Obviously, in the event of default. And settlement risk is all about taking actual possession of the collateral or the cash, depending on which side of the transaction you are on. Now, as I said, there is a pretty neat solution. I was going to say simple, but it's not necessarily very simple. It is, however, a nice solution to potentially manage these risks. So let me write over here, to manage the above risks. We've got something called the tri-party repo, which basically involves three entities rather than the classic two. It's not going to be just a borrower of cash and the lender of cash. That would be known as a bilateral repo if it only involves two. If it involves three, it's a tri-party repo, and it involves a third party sort of external agent. So what will happen here, and this role is performed by kind of specialist institutions, in Europe, Clearstream, Euroclear do this. Elsewhere, some financial institutions like BNY Mellon, for example, offers this. What you're going to have is your kind of original cash borrower, who's going to be the securities or the security lender on the one side. Over here, you're going to have the cash lender, who simultaneously is the securities borrower, of course. There's always that two-sided nature of what we do here, and they mutually agree between them the details of the trade, of the repo agreement, but they do it via a third-party agent. So let me draw them here. Third-party agent, like one of the institutions I just mentioned, and they will be the one who kind of coordinate the flows, and everything will actually go via them. So the cash lender and cash borrower will not transact directly. There will be payments going this way, flowing that way, payments going this way, flowing that way, but everything will pass via or through this third party. They will hold the cash in separate accounts. They will hold the collateral, so holds cash, holds collateral as a kind of custodian, and they obviously do this for a fee, but the important thing is they, first of all, I mean, there are two things to appreciate. The third-party agent typically does not assume the risk of credit or credit risk or default risk. So in the event, for example, that the cash borrower gets into trouble and kind of defaults, goes bankrupt, it's still the lender's problem whether they will be able to, whether their claims will in fact be satisfied. Obviously they've got the collateral, so that should be fine. The question is, will the collateral be enough to cover the loan amount? So the third party doesn't assume that risk. They only help to sort of coordinate the whole transaction. But the very important reason why you use them these days is because they provide cost efficiencies. So let me say provides cost efficiencies. They will have these third-party agents, they will have whole teams whose job is to perform collateral valuation. And there are specialists in this, performs collateral valuation. So you don't have to, as one of the original sites to the repo, collateral valuation services. They'll kind of, as a result, they'll be taking care of issuing the margin calls, which then lead to the transfer of margin, variation margin between the sides, and they kind of coordinate the flows. They keep the assets safe, so asset safekeeping, all of these things that you don't now have to worry about if you are one of those two original sites. In the past, it used to be that pretty much banks had the resources to engage in repos with their clients. Nowadays, it's the introduction or the invention of third-party repo services has opened up this market to a much wider audience, or a much wider group of participants who don't necessarily have to be, neither one of them has to be a bank in order to enjoy the benefits of participating in this kind of transaction. Also, these third-party agents, because they deal with many clients, they will typically give you an access to a wider base of counterparties, and therefore also a wider base of potential collateral that you may wish to borrow, for example, if you want to do a short position, short sale. Now, final point in this video is repos, and this is once again under the heading risks. We head up here, after all, we head up here risks of repo agreements, and there is another big one which tri-party repo will not necessarily solve. Remember that repos are predominantly, they are mainly very short-term transactions. In particular, many of them are overnight, and they are uncommitted forms of lending, which means nobody says that after one transaction, an overnight transaction is over, they will be happy to extend the credit, the loan, for another day or another period. So the problem is, because of their relatively safe nature, the plus side of it is they are relatively low cost. It's a low cost way to achieve short-term funding. Okay, low cost short-term funding. Especially good if you're a financial institution, for financial institutions, because financial institutions hold a lot of the securities that may be used as collateral. But the flip side of this is rollover risk. And as a result, liquidity risk as well. Nobody knows, or nobody can guarantee to you that once one repo term's over, you'll be able to get the funding for another overnight period or a couple of days. And this becomes a problem because then you can't get the extra funding to support your positions, and you may end up having to sell the securities just to get out of the liquidity trap that you've gotten yourself into. That may cause a big drop in market prices of bonds, for example, if everybody's trying to do the same. This rollover risk is going to be especially problematic in times of market stress, especially true in times of market stress. Normally it's not a problem, but you know, when conditions become tough, it is going to be a problem, because in times of market stress, financial institutions typically are unwilling to lend to others. They lose trust, they lose confidence in one another's financial situation. They don't want to risk it, and anyway, they rather want to sort of bring cash back rather than lend it out. They want to hoard cash, they want to keep cash at home rather than lending it out to others. And you know, remember, the rollover risk aspect comes from the fact that your counterparty, the cash lender, may decline to renew or roll over your existing repo trade. So yeah, that's the tough bit of it, as certain financial institutions discovered and found out the hard way in, for example, in 2008, at the time of the great crash in the markets associated with the subprime credit crisis. Anyway, this is a trade-off. On the one hand, you've got cheap funding, cheap borrowing. On the other hand, it's risky because you don't know whether you'll be able to keep it going and sustain it and roll it over. There are other funding alternatives available to financial institutions. Financial institutions may issue bonds, long-term bonds. They may issue shares, but those sources of funding definitely come with a higher cost. So, you know, it depends on your risk appetite. How much will you rely on this short-term but rather unpredictable funding? It becomes unpredictable in times of market stress.